Hi everyone, thanks for joining in our session. It's another important session which we are doing, and today we will be talking about all the compliances which a global investor requires to do in India while investing in India. So I've got Somik also from my team in this LinkedIn Live. So India is has become a very important destination for global investors. India is already third largest startup ecosystem. India, with the changed geopolitical scenario in last 3 4 years, many of the manufacturing shifting to India. Uh, India is at a very strategic, important situation to attract more capital and more investment as we move forward. As India travel its journey from where we are today, which is close to 3.8, 3.5, 3.85 trillion economy to a 10 trillion economy. Uh, so, so in this LinkedIn Live, we will talk about all the compliances which are required. So there are three reasons why India is attracting so much of capital now, right? Where China was there, China was 20 years back, or US, which US was 30 years back, where we are today. So number one is low cost capital. Uh, Number two is strategic location in terms of a gateway to both east and west, and we have a diversified economy. I think these three factors plus the the large population, the domestic consumption, uh, economy which is really growing fast in terms of technological development. So if you take everything into account, India is at a very interesting position to attract more capital, right? So as we move forward, Swamik, if you can move to the next slide. If we move forward, we
Right. I think I'm trying to move forward, but something is not working. But I'm trying to sort it out.
yes,
But give me a minute to change the slide. But you can continue, sir.
yeah. So basically, uh, in terms of where the country is today, and in terms of the the global investment, what we're talking about, it is very important for global investors to also understand in terms of what are the compliances they are required to do while investing into India, be from RBI or from Ministry of Corporate Affairs, which is MCA, or from income tax laws. So these are the three main areas wherein you need to cover while investing into India, be it into different sectors which you want to invest into India, right? So Somit, can you can go back and then restart this PPT? I think that will help.
Yeah, I am just trying to just give me a second. I'm stopping my share screen.
So and as a firm, we at Tax Mantra Global TMG, we have helped many global investors and VC firms and micro VC firms to invest into India, uh, to start up the manufacturing entities in India. Uh, we have a large presence in Singapore. We and through Singapore also we have helped a lot of industry houses to invest into India. So I think that coupled with what's happening in the ecosystem really brings us at the center point to support the global investors in terms of what support they require for investing into India. Somik, are you able to resolve this?
Yeah,
Yes.
I'm trying.
So do one thing. You unshare and then share it again.
So that's what I'm doing. Uh, uh,
Yes.
uh,
And
are
then
you
again you can start.
uh,
Yeah.
just
Then yeah,
second?
I can see. I just go and start again.
Are you able to?
I'm able to see your screen. Just go and start again.
Uh,
Yes.
Sir, is it visible
Yes.
now?
Yeah, yeah, it's working now. So, sectors which are important for investments are technology, financial services, consumers, healthcare, and infrastructure. These are the five main sectors which is attracting a lot of investments. You can go to the next slide. Uh,
I think again it has stopped. Is it now visible?
yeah, yeah. So, from this point, I will move this to Somik as he talks about the specifics in terms of ways wherein you can invest into India and in terms of different structures. So, over to you, Somik.
Great. I think Alok, as mentioning, I'm sorry, ladies and gentlemen, for this technical hiccup. I mean, so some problems due to technicalities have arisen, but nevertheless, what we are trying to understand over here is that the different types of mechanism through which a global investor can invest. So, say, for example, if you're an NRI, if you're a global VC firm, whatever if you want to invest in an Indian startup, then what you should do is to follow this various sort of mechanism that we will discuss in this webinar. The first thing that you should do is to understand how you can invest in an Indian startup. There are various ways and mechanisms to invest it. The some mechanism would say it's called preferential allotment or private placement, and that is a global investor who's investing is allocated a specific pool of the company as investing for a particular amount of subscription money. This has to be done at a particular valuation, and the valuation and how people arrive at the valuation will be discussed at a later slide in this webinar itself. But you need to remember the options through which investment can happen is either private placement or preferential allotment, convertible notes, including investment in the memorandum and article. If you just invest in an Indian company through equity shares, you can invest. There is an option for right issue, wherein the existing shareholders give out their rights, and a foreign shareholder can invest in that regard. And of course, you can directly purchase from an Indian resident for a equivalent amount of money, right? Now, while you invest in an Indian startup, ladies and gentlemen, you need to follow three important criteria or three important regulations. One, Companies Act 2013, two, Reserve Bank of India guidelines, and three, income tax norms. These three norms has to be followed simultaneously. Only and only then you will get a very sort of a easy exit during the time of investment. Otherwise there will be complexities that will be arised, right? So you need to follow all these three regulation, and this three regulation should be done in sync manner. So say for example you're following corporate act and then not Reserve Bank of India guidelines, so for that matter you're following both RBI and companies act, but not income tax guideline, then there will be a difficulty that will be arise, especially during your exit and sometimes even in the period of your investment, right? Now, for the next perspective, let's just understand how the process happens over here. When you invest in a company, there is a particular process flow that has to be undertaken. One, convening the board meeting. C, uh, holding and general meeting, that is all the shareholders should approve your investment. Until and unless that happens, it will be difficult for you to invest in the company in a proper compliant way. So all the shareholders, or at least 95% of the shareholders, should approve your investment, or only then you can invest in the company. For governance perspective, because we work as due diligence managers for many global investors, what we check is that the who are the investors who have not agreed to it and what is the reason behind it. If we find that the reason is non-availability, then we can ignore it. But if it's available and they have a issue on it, then we give a orange flag to our client to understand that whether to invest or not to invest. Again, coming that into be it as it may, after this, we receive the funds. Once this to compliance has been done, we receive the fund, and there is conditions that has to be fulfilled after receiving funds. So any investment that takes place have two perspectives: one CPs and one CS. The CPs are those that will be taken before investment takes place. The CS are those that will take place after any investment would have happened. Now, many a times what happens, and this happens especially in the Series B, Series C rounds, when investors purchase shares from the other existing Indian investors. So, say for example, I am based in India, and Alok is based out of say Singapore, and Alok wants to give me exit. By purchasing my shares, then these are the things that has to be followed, which includes changing, referring the article of association, following the Ministry of Corporate Affairs guideline, and then Reserve of Bank of India guidelines to SMF form. So again, it's very important to fill in the RBI guidelines, because if you do not do it, in case you transfer the money, you get the shares, and you do not fulfill the RBI guidelines, your shares will never be acknowledged by the government. So once what we get frequent cases where Series A or Series B investors, especially angels, uh, buy out shares from very early stage investors, but they do not do the RBI filing. So this has to be checked. Otherwise, even if you get the share being transferred, it will never be recorded in RBI, and your shares will not be acknowledged by Government of India as the true shareholder. And when you get it, you try to get an exit either in IPO or a late stage M&A, then you won't be able to secure that sort of leverage on this. Coming to the next slide, as I was saying, this entails during the time of your investment, your reporting. There's a thing called FCGPR reporting. The FCGPR reporting states about what are the documents, what are the details based on which an investment has taken place. So, say for example, and this is of very importance, is that when you fund in the money, you should fund in from a global banker, not a local bank, because while channelizing the fund, a SWIFT code has to be transferred to the Indian bank, right? So the SWIFT code will entail your details, your credentials for the last years that you are maintaining the bank account with them, and what are the various sort of formalities that has to be undertaken through this transfer. Why the transfer is getting made? Because many a times what happens, there is a particular port through which the transfer has to take place, and investors do not know, and they transfer the money for different port. Now, when port is different, right, the banks will not acknowledge the fund, and the fund will be repatriated back. So while making it very sure that the ports are done properly and not on an abrupt basis. Now again, during the time of sale of shares, there are FCTRS guidelines, and again, these codes will come in handy. This SSU code and details will be very important during the time of transfer. You have to follow on the FCTRS guidelines, when you have to create your own master data and then file the SMS form to the government, and this has to be done within 60 days. The government usually approves it if it's done properly and filing is done in a diligent way. And once that is done, I think every year you have to report the same to the ministry. The reporting part is again done by the company, not yours, but you have to make sure that the company undertakes it. Otherwise, there will be complications that will be arise at a later point of time. Coming back to the valuation, now, is a valuation necessary? The answer to that is yes. Whenever you invest in an for valuation has to be undertaken B or B not B is a price round. Now, say for example, many a times investors invest to save, right? Now that's all fine that you can go ahead with save round, but you have to do some sort of valuation because it's mandated by the government of India that valuation report has to be filed. So one has to undertake this valuation to be done. Now, valuation can be of various facets, but usually the most common valuation technique is of DCF method. So you need to follow the DCF method, and only then the valuation has to be undertaken properly, right? Coming to the income tax guidelines over here. Now, the income tax, when you issue the fresh equity share, then of course there is no fair market value. Is not done on a valuation. It's just only face value. So there is no taxability. But while you do it at a above fair market value at a later round, when a price round has taken place, if you do shares above the price round, that is, if say for example the price round values your company at 100 rupees per share, and you do it say at 200 rupees per share, then the company will be taxed, right? Uh, at 200 minus 100 rupees per share. And again, if you do at say 100 rupees per share is the valuation of the company, but you do at say 50 rupees per share, then again that 50 rupees will be taxed on your hands. So one needs to understand and undertake that procedure accordingly. Alok, any point on this?
No, I think what you are suggesting is correct. And uh, in terms of the implications some of the implications have recently changed also with regard to valuation under startups. So I
Right.
think those factors needs to keep in mind in terms of, and we have done a very detailed video in terms of how this valuation works. So we can share the link of that video in terms of different valuation systems which are there now.
Right. So, the reason I didn't put it into perspective because there's a whole lot of things that are there in the webinar wherein we have covered the various facets that this valuation process will undertake as per the new guidelines that has been issued, and that would need to be taken care of before any investment is over there. Uh, in terms of there are certain exceptions. Again, these exceptions are well mentioned in the valuation webinar that we have undertaken under Startup India guidelines, where the exceptions would have what are the reasons and how this valuation report or is not mandated, and what are the mechanism of Startup India sort of benefit, right, and the income tax guideline. Coming to the last point, before any investor invest over in a private limited company, you should do a bit of research. You need to work with your local partner on this, a compliance partner who would understand the nuances, because uh, the investor coming from their zone, their regulation is quite different from our regulation. So you need to understand the common regulation, the cross-border regulation. Only then you will be able to leverage the benefits when you do an exit. And it's a long term process, as we all know. So you need to have a proper compliance setup undertaken, and only then this investment will be beneficial in the long run. So that's about it from our side. We have tried to prove a very gist sort of framework so that one can refer it. There are certain nuances that will be coming on detail because each part has its own sort of mechanism, which we will cover in the days to come, wherein we will discuss on each part on each webinar. This webinar is done to give you an overall overview that what has to be undertaken, but a detailed webinar will follow for each and every part, wherein we will discuss the corporate law, this is the Bank of India guidelines, and the valuation report as a part of each of them, right? So, any questions you can drop in at info@actionable.com, and we will be happy to answer them. and we can from there onwards take this forward. Right? Alok, any point to add?
Thanks, Swamik, for this. No, it's a great, informative webinar, and happy to support any queries which you might have in terms of investing into India via different route, while you're investing into a startup or doing into a established entity or doing a secondary. We are happy to support and do. So thanks.